Welcome back to Everything Money. As always, it's Seth, Paul, and Mo with your insider stock analysis advice. That's not really true, but
I was going to say, like insider. What are you talking about?
BS
it's on YouTube. How's that insider?
Yeah, it's insider. It's to everybody. What we do on this show, if you this is the first time you're seeing us, it's my normal person. Your questions you might want to ask two dudes that control and manage a lot of money and a lot of funds. And we're trading, we're real estating, we're building businesses. Obviously, everyone's loving stocks in the past year, so we analyze a lot of them. And today we're looking at Apple, one of the most famous companies in the history of the universe of the world. I love it. Paul loves it. Mo loves it. Even when you don't love it, you kind of love it. I remember in the past decade, that whole you're going to drink the Kool-Aid type thing. And I was like, I'm not doing it. I'm anti-Apple. And then, of course, while I had like 4 iPads, 2 iMacs, and all the phones.
You were anti-Apple?
Well, I guess in my mind,
I thought corporate world?
I guess, yes, that's probably it. I thought I was, yes. I was anti-Apple. Meanwhile, I was
You're the biggest Apple fanboy in the world. So
I had to fess up to myself that I was very pro-Apple. So
I remember in high school, one of our history teachers was buying a new Apple, and I was like, loser. Literally we thought.
That's what I thought too. Yeah,
for sure. Loser. But that's because Apple was dead in the late 90s. I mean, it just started to rebound with Steve Jobs coming back.
Yeah, I see. Of course.
Apple's an interesting story because a few years ago, we know somebody else is a huge Apple fanboy, and he asked me, "What do you think of Apple?" I said, "Listen, Apple at that time was selling for like 9 times earnings, incredible numbers." I was like, "Listen, this is a buy all day. If you think Apple can sustain it just stay the same."
Yeah.
And it's since the revenue's skyrocketed. So it's like, Apple's just amazing.
So what we do on the show is we like to look at a stock and then use our screener, our 8-pillar analysis to see, are we interested in learning more about this? Have we done our due diligence? No. Have we read a bunch of articles? No. Are we listening to other YouTubers in their bedroom tell me about Apple's insider news? Not really.
And do we care if you say you didn't do our due diligence? No. That's the point. We start at a high level with the numbers, and if it justifies learning more, and we say these numbers are interesting, and then we go do more due diligence to decide if at that point we want to proceed to buying the stock. That is the way you should do it. If you think it's the other way around, you're going to waste a lot of time finding the right situation at the wrong price.
Let's not waste any more. Let's get after Apple. Obviously, there's not much you need to say. It's headquartered in California. They make 1 billion computers, phones, iPads, everything all over the world. Every time they come up with something, it just rocks the world. The earbuds, everything. What's the market cap for Apple, baby?
$2.2 trillion. PE of 28. That's an X. Nice profit margin of 23%. That's a check. A small little dividend of 0.63%, paying out $13.75 billion. Last year, they did free cash flow of $90 billion. So remember, guys, your dividends, for those of you who are new, everyone thinks dividends are safe. They're not. You need to look at the free cash flow, which is cash from operations less your capital expenditures, and make sure they can easily support the dividend. Because a lot of companies will issue a dividend by issuing debt and will pay a dividend out because they know people are going to like seeing that dividend and buy the stock, and it props the stock up. Make sure the dividend is sustainable. In this situation, it is definitely sustainable. It's only eating up 15% of their free cash flow. Another thing, look at their return on invested capital and return on assets. They make an amazing amount of money off their invested capital and their assets. Incredible. This is an absolutely incredible company.
Show me the ridiculous revenue over the past 5 years for Apple.
Revenue growth of the last 5 years, 220 to 325. And I think it was around here where they asked me, what do you think? I was like, is this even sustainable? Is this revenue? Oh, yeah, I was wrong. Now, they did have a big jump last year. Look at this. 267 to 325. That's a big jump. But the bottom line is it's incredible.
Now, you're on a PC right now, right?
I love PCs.
You do?
I love my iPhone. I like iPads, but I just like PCs for my desktop and laptop. Every time, the only reason I liked my MacBook was for iMessage. It's kind of better to not have that because now I don't spend as much time. I still do spend a lot of time. I just like PCs more for Microsoft Office and things. And I only use it for that.
Maybe I have drunk the Kool-Aid because I do buy
Well, you're a media guy.
Yeah. So
I do think media is better, from what I understand, on Apple versus PC.
Yeah, but I get the iMac Pro, the $5,000-$6,000 computer, and I get the big stuff for
good
videos and photos and all that. Okay, let's keep going. What are we on now? Shares outstanding? Yes, shares outstanding.
No, profit growth.
Oh, profit growth. Pillar number 4, Paul.
45 billion, 76 billion. That's a chickadee check.
Shares outstanding. We want this number going down. We would love to see them buying back shares, Paul.
And they are.
Oh, wow.
20.9 down to 16.75 billion. Now, guys, this software here, you're going to be surprised. 80 cents per day.
Paul's talking about the software behind him. This is the Everything Money software you get as a Patreon member. if you're drawn to these numbers, just math and looking at this when buying a stock, you can have this software today by becoming a member of our Patreon. The link is in the description
and
below.
it gives you so much more: stock analyzer tool, real estate calculator, whatever you paid today, you're stuck at. As the price goes up higher and higher for future levels, you're still at the same price you paid today. 80 cents per day. It gives you all the 8 pillars. Don't be stupid.
You also get a Discord chat.
Yes.
And the chance at winning one of the 2 Tesla Model 3s we're giving away to our Patreon members. Here we go, Paul. Keep going.
121 billion in cash on hand, 106 billion in current liabilities. They have plenty of money to pay off their current liabilities.
That was
now
current.
for the big.
Go ahead. I was just saying that was pillar number 6. Pillar number 7 is free cash flow growth, Paul.
54.5, 90.47, check mark, with an average of 60 billion. 60 billion, we always pick a multiple of 20 as a starting point because there is increasing free cash flow. You want to pick some number to start at. That's $1.2 trillion. So it's an X right now.
Yeah, because the current market cap is 2.2 trillion. Oh boy.
Now, let's take this. Let's take the last year and say 90.4, 90.5 times 20, it's 1.9 trillion. It's still an X. So guys, this is a little rich. Now, it's a hype. A lot of people like Apple. They think it's incredible. It's a big company. I don't know if I'd pay such a big multiple. Once we're done with Mo looking at the charts, I'm going to show you the stock analyzer tool. We're going to make some assumptions and see if it's still a reasonable amount of money. Because the one thing I'm interested in is they're buying a lot of shares back. And that gives you a bigger piece of the company. So when we're looking at the 8 pillars here, guys, and like I said, look at these 8 pillars. Look how amazing this is. The only 2 X's we have are valuation X's. So this tells me that everything else in the company financially looks pretty solid.
Except the price.
Except for the price. And by the way, the price might be okay. You know why?
Yeah.
They're buying tons of shares back.
Yep.
If they continue buying lots of shares and the revenue and profit and free cash flow can increase, they can buy back so many shares that it gives you so much growth in this per share cash flow and profit, therefore magnifying the value of each share.
What Paul's talking about is long-term fundamental investing. If you want to trade this at a little more quicker pace, you can join Mo in the Business Nation, where he's trading with people on a daily basis, whether it's 1-day swing trades, day trades, 3-week trades. And you really just cover up the name of the company, Mo, and just watch your trend lines. What do you got for Apple?
Looking at Apple, I mean, it made that all-time high back here, but if you just draw a line across, you can kind of see that it's kind of stuck at this 140, 144 area. But yesterday, it had a great day. There was an announcement of, something, I can't remember, some kind of news. But this thing moved right into the sweet spot, and we are heading up. So all I'm looking for are green engulfing candlesticks moving up now to try to get, I want to get to this 137 area. This is a good stock.
You're going to wait? You don't buy now?
No. I'm going to wait as long as I can get. That's a great question. So we're in the sweet spot. I'm very happy with this. We have our second day green in a row. That means we've been in the sweet spot for 2 days. That's great. All I'm looking for maybe tomorrow is a green engulfing candlestick like that to take out this little doji. That's a little doji candlestick today. And we can go ahead and go from there. If you watch Trading 101 series, you wouldn't be laughing. You know what that is.
Well, it's because of the Dogecoin, right?
Dogecoin, yeah.
Yeah.
Okay, that's good news. I mean, we're headed over the 32%, but we need more candlesticks, baby.
That's what we need.
Paul, what do you got behind you there?
Guys, this stock analyzer tool is awesome. Like any other metric, like any other tool out there, what you put in is the most important part. It's asking you for your assumptions. You pull up a company like Apple. It'll tell you it's last year, 5-year annual growth, and 10-year annual growth for every metric you need. Then you put your assumptions in, and it'll tell you how much you pay for the stock based on what your desired return is. So, annual revenue growth. Last year was 21.4. In the last 5 and 10 years, it's around 10%. I'm a value investor. Do I think the future is going to be just as good as the last 10 years? I do not. So I want to sit there and go, okay, let me be more conservative and say 7% growth. Share buyback rate. They've bought back 4.7% a year over the last 10 years, 6.34%, 2.88%. I think this will be a continuing trend. I'm okay going with a 3% buyback rate.
Wow.
Net present value. That's what return do you want to make per year in your investment? The market's going to do 10% a year, so I usually put in 10% for the value I want for what it's worth currently. Future PE. I do believe it's a 15 PE. As exciting a company as innovative, it's so large.
It's hard to grow when you're this big. You can't grow
they're the
these
biggest
leaps and
company in the
bounds.
world.
Yes, I even think I just look at it going, even 7% revenue growth a year for the next 7 years might be difficult because they had such a big jump last year. So for a PE, I'm still going to call it 15. Profit margin, it's been low 20s. We'll call it 22%. free cash flow as a percentage of revenue, if you look right here, has been about 25%. So I'm going to put 25% in. And a free cash flow multiple, same thing, 15. How many years of analysis do I want? 7. So when I hit analyze, down below is going to pop up 2 prices as a factor of multiple of multiple of earnings and a multiple of free cash flow. It's going to tell me 2 prices to pay for the stock. Those 2 prices I'm going to look at as a gauge. The current price of the stock is
130.
It is currently telling me I should pay between $66 and $75 per share. Okay? A lot of people might look and go, oh my God, that's too little. Maybe so. But I'm just sitting there saying, based on these assumptions above, this is what I need. I need to pay between $66 and $75 a share to make a 10% return. Now, how can this be affected? Well, let's say you get aggressive and you say, you know what, I think they're going to do 10% revenue growth a year. They're going to buy back 4% of their shares. They're an amazing company. They justified 18 PE and an 18 multiple of free cash flow. From $66 to $75 a share, it jumps to 85 to 96. The bottom line is, guys, it's overpriced. Because even being more aggressive, it still is selling for below where it's currently at. I just think it's an overpriced company, but it's definitely a company I want to own as the price goes lower. As a value investor, am I buying at 135 or whatever it's at? No. Am I buying sub 100? Maybe. I'm probably taking a look at it at sub 100, see how they're doing, but I'm definitely buying at half the price where it's at today. You might sit there and say, it'll never drop in half.
It was there just before COVID. It was
well, not only that, go look at the last 10 years, guys.
And just in COVID, the low is 53. That was pretty split, but
last 10 years, September 2012, $25, got as low as $15 in 2013. Not a half, but it fell. Mm-hmm. Right here, high of 33, a low of 23.24 in 2016. A high of 57, a low of 39 in 2009. There are big drops for Apple. They do happen. They will happen.
Apple's one of the big reasons that the market, it's one of the 4 that has driven this market as high as it's been. So you have to think, and proof is in the pudding, that it's the one that leads the market down when you do get big pullbacks.
Yep. So be patient with Apple. I think it's a great company overall. All the financials I love, as you saw from the 8 pillars. The 8 pillars just tell you this is a company you want. We love the story. We love the products. They dominate. Just the valuation. Because guess what, guys? Ferraris are the best sports car out there. Let's not argue. Let's just assume that's the case. Doesn't mean you pay $100 million for a Ferrari. Mm-hmm. You still sit there and go, well, what's it really worth? Same thing with a company. A dollar of cash flow is a dollar of cash flow. I don't care who creates it. The future cash flow could be different, but this is a huge company. They do $325 billion in the last year. Is it really reasonable to say they're going to grow 10, 12, 15% a year? Is it possible? Yes. But as an investor, your job is to pay what's probable for a company, not what's possible.
That's our take on Apple. Fondle the thumbs up on the way out. Join the Patreon if you feel alone out there in your investing journey. You can join our teams, get in the Discord, and talk with people all over the world about these disciplined, math-based decisions in terms of buying. Love you guys. Love the patrons. Join us on our live streams. Mo in the morning, 9 a.m., 1 p.m. Eastern. We go live every single week. Thanks, guys. See ya.